We posted revenue growth of 3.5% quarter on quarter in constant currency and 10.5% year on year. We also continue to execute well, keeping our operating margins within our guided range of 19%. The market continues to be very strong for services, especially our digital business, engineering services, and cloud services. Our services business, representing more than 85% of our overall overall business, this portfolio grew 13.1% year on year and 5.2% quarter on quarter in constant currency. The growth in services business was fueled by growth in both IT and business services and our engineering and R&D services. Especially our Mode 2 offerings delivered 36.6% growth YOY and 12.5% quarter on quarter growth in constant currency. We had fabulous client additions across all categories, reflecting a strong broad-based demand and relevance of our offerings for all segments of our clients. We grew our $100 million clients by 1, $50 million clients by 4, $20 million clients by 5, and $1 million clients by 19. We won 14 large new deals, net new deals during the quarter. Our net booking was $2.25 billion, which is a 38% increase year on year. The deal wins were across telecom, life sciences and healthcare, manufacturing, and other verticals. Many other deal wins were also incremental revenue from our existing clients in financial services and retail CPG and other verticals. Last quarter was a very, very busy quarter for us. We witnessed the highest net hiring number ever in our history in a quarter. Our net addition was 11,135 people. We welcomed a large number of new HCLites into the HCL family. Given the bookings, given the pipeline, all these numbers and the hiring numbers, these are all auguring well for our business going forward. The last quarter, we also got a landmark recognition in Gartner's inaugural public cloud IT transformation Magic Quadrant. HCL was rated as a leader, and we are the only India heritage provider in this group, and actually the only non-consultant full stack IT services vendor in the top global cohort. This is a great validation of our capabilities in cloud transformation, which is really where the tailwind for the entire industry today is. A cloud transformation driven digital business transformation is where the significant tailwind exists. Also, we got recognized as leaders in the Forrester Wave's application modernization and migration services released last quarter. We are seeing rising awareness and traction for HCL's unique offerings in the application space. And this is increasing by the day. And you will start noticing this in our numbers and growth trajectory going forward. It will only get stronger. In fact, you will see that in the numbers that I've shared with you, we built a market-leading momentum in the tech modernization and end-to-end digital transformation space across applications, infrastructure, business process, and engineering, all of which align very well for midterm growth for us. I'm also happy to share with you a hot off the press news. HCL has once again made it to the Forbes list of world's best employers. This time we emerged as number 1 among all professional services organizations and leading the ranking in the technology services industry globally. This is an amazing recognition. We are also among the top 5 multinationals headquartered in India across all sectors in the Forbes list. This is a tremendously influential global recognition and one that is reflective of our commitment towards fostering a culture of empowerment and innovation among our employees. This quarter, we also got another validation for our employer brand on the back of the Forbes Best Places to Work Global citation earlier. HCL America now is certified as a great place to work for 2021. 78% of our employees in the United States said it's a great place to work, 19 points higher than an average US company. As a company, we retain a razor sharp focus of our employee value proposition and will continue to invest in making our workplace and HR practices more and more modern, more globalized, innovative, and talent transformative. With that, let me throw some light on our segmental performance. In terms of segments, our IT and business services grew 5.2% sequential and 13.2% in constant currency on a YOY basis. Our digital business, embedded in the application offering, continues to grow at a very fast clip, likely faster than the industry, providing impetus to the overall growth, led by various propositions like industrial commerce modernization, client experience transformation, and data and analytics adoption across our clients, as well as we get positioned as a challenger where some of the traditional providers are entrenched. Accordingly, we brought home many defining large deals across manufacturing, life sciences and healthcare, high tech, and a very large uh, retail CPG firm, Europe-based retail CPG firm, where we were the beneficiaries of a large consolidation initiative. We're also scaling up very nicely in our application business across a wide cross-section of our financial services clients. Led by a strong demand for Industry 4.0 digital engineering, our ERS business posted a robust 5.4% sequential and 12.7% YOY growth in constant currency. Uh, it's notable to mention here the asset-heavy industries, which saw the big impact due to COVID in the last year, has recovered very smartly, and we are very confident of the growth trajectory in the asset-heavy industries because a lot of new programs have kicked off in these industries. We're also seeing the digital ERS propositions, which we've been incubating and launching in the last few quarters. It's gaining more and more traction, led by IoT, 5G, and Industry 4.0 propositions. Leveraging our core and digital ERS propositions this quarter, three leading technology companies in the US entrusted their product transformation journey to us to develop new use cases for products, improve product revenue, and increase their market share. It's really heartening to see our engineering services reach its pole position in the market, even as the sector moves from traditional project work to digital engineering-led end-to-end transformation. We see a lot of growth potential in our engineering services driven by our Mode 2 digital engineering propositions. Our products and platform, as I said earlier, had a degrowth of 5.5% year on year in constant currency this quarter. This team has delivered exceptionally well for the last 8 or 9 quarters since its inception. But this quarter, there was a blip which was attributed to delays in closing some large deals, which is normally done, which is likely to get done in the next quarter. Usually, the product business has a lot of license sale of our products, and a big part of the revenue gets booked and recognized towards the end of the quarter, and some of the deals slipped into the next quarter. I want to assure you the core of this business is intact, though we overall expect this year to be flat to 1% growth compared to the low single-digit growth that we had shared earlier. In terms of verticals, growth this quarter was led by manufacturing and life sciences, with life sciences delivering 20% year-on-year growth and manufacturing delivering close to 12% year-on-year growth, and a sequential growth of 8.1% and 7% respectively in constant currency. Our manufacturing vertical has brought many large, complex, end-to-end integrated deals this quarter, while life sciences continues to propel on the pandemic-induced aggressive growth trajectory. Telecom and media, technology and services also posted a healthy performance with 3% and 2.6% sequential growth in constant currency. In terms of geographies, our performance was led by Europe with 5.8% quarter on quarter and 9% YOY growth, again in constant currency. We signed many large deals in this geography. You would have recently read about Proximus. This is a very interesting engagement where we leverage the whole telco modernization proposition covering 5G, Edge, IoT, and this has really become a template for a technology transformation in the telecom space. And we believe this will open up a lot more opportunities in the telecom segment for us moving forward. Americas posted 2.8%, 2.4% sequential growth and a 10.7% year-on-year growth. It would have been better if the product deals also had come through. ROW came in at 4% sequentially and 14.9% YOY in constant currency. Our pipeline across all regions remains strong. We continue to hire aggressively to augment both our sales and delivery talent pools across the world to continue to align our demand and supply needs. Looking ahead, we remain very positive of our near-term growth, confidence generated by our strong bookings and pipeline numbers across every segment, compounded with the very solid net hiring numbers that we have been accomplishing over the last few quarters. We also believe the upward demand trajectory will continue. Enterprises will continue to invest in modernization, cloud journey, digital transformation for the next few quarters. And the first phase of investments will last for a few quarters, and customers are going to revalidate the proof points and really kind of double down on some of the initiatives which is giving them the right returns. That's what we see. So we see it as a good midterm trend, the overall growth trajectory and the demand situation. Our aim is to continue to build a future-ready organization that's a digital front-runner, employee-centric, globally diverse, and a sustainable business. We've also onboarded a global sustainability head supported by a team of dedicated experts to integrate sustainability in our day-to-day operations and also ensure that our ESG propositions result in higher value creation for all our stakeholders. For our current work in this arena, I encourage you to visit our website, the sustainability section, for you to get a good glimpse of what we are doing. We're also very happy to announce that our board of directors have approved an RSU plan, which will cover a greater number of leaders, and Apparao will talk a little more about that. We're also very happy to share that our board of directors have approved a payout policy as requested by many of our investors, and Prateek in his commentary will share more details of our formal payout policy that has been approved by our board. On that note, I will hand it over to Prateek to provide more highlights, and then Apparao, and then we will take questions. Thank you, and over to you, Prateek.
Thank you, CVK. Season's greeting to all of you, and best wishes for the festive season. I'll quickly go through some of the highlights from a financial perspective. The highlight of the quarter, obviously, is the services revenue growth, which is at 5.2% Q-on-Q sequential and 13.1% year-on-year in constant currency. It is comprised of both ERS, engineering and R&D services, growing at 5.4% Q-on-Q and 12.7% year-on-year. In doing so, it crossed the pre-pandemic peak, which was around 425 odd million. IT and business services also showed equally good growth at 5.2% sequentially, and even better 13.2% on a year-on-year basis. P&P, as CVK has already covered, saw a deferment of a few deals and showed a decline of 5.5% year-on-year in constant currency. On a last 12-month basis, P&P growth is at about 3.6% in constant currency, So this quarter is a point in time, a blip, but the long-term health of the business continues to show a 3.6% in the last 12 months. At an overall company level, the revenue for the quarter is at 20,655 crores. So we continue to sort of ratchet that up quarter after quarter. In constant currency, that at a company level went up at 3.5% sequentially, and on a year-on-year basis, it was 10.5% in constant currency. The Q2 EBITDA came in at 24.3% as per Ind AS accounting, Indian accounting standards. And profit after tax for the quarter stood at 3,265 crores, which is 15.8% of revenue. The highlight of the few other highlights during the quarter were the deal wins at $2.25 billion, and that is a growth of 35% sequentially, and on a year-on-year basis, 38%, which is very robust growth. The second factor which helps our growth going forward is the net hiring, which on top of close to 20,000 that we had done amongst employees as well as third-party contractors in the last 2 quarters. This quarter, we had 11,135 net hiring in employee base and slightly less than 1,000 in third-party contractors as well. So the total has gone up over the 3 quarters to something about 32,500 people. Better mining has resulted in all our customer categories in terms of dollar million segments that we call out. Particularly notable is in the 50 million plus category on a last 12-month basis, where we grew by 4 customers crossing the line of 50 million on a sequential basis, and on a year-on-year basis, that number went up to 41, increasing by 12 numbers on a year-on-year basis. Even in the 100 million plus category, that number of clients increased by 1 customer, both sequentially as well as year-on-year basis. The cash generation and cash conversion continues to be excellent. During the quarter, we generated operating cash flow of $465 million and free cash flow of $390 million. And the percentage of net income works out to 106% for OCF as a percentage of net income, and 88% free cash flow divided by profit after tax. On a last 12-month basis, OCF operating cash flow is at 2.05 billion and free cash flow at 1.8 billion, which works out to 117% of the net income for OCF and 103% of net income for free cash flow. LTM OCF and FCF yields remain at 4.4 and 3.8% respectively. From a shareholder perspective, the last 12 months diluted EPS is at rupees 49.5, leaving out the milestone bonus, which was a one-time exceptions. This 49.5 is an increase of 9.5% year on year in terms of last 12 months over the previous 12 months EPS earnings per share. As CVK pointed, our payout policy has been revised. The board has approved in the board meeting today revised policy of paying out not less than 75% of net income cumulatively over a 5-year period, fiscal year 22, current year up to FY26. So that's what the starting this quarter, that's what we are targeting, something like 75% of net income. And accordingly, in line with that policy, the balance 3 quarters, we expect the dividend declaration to be rupees 10 per quarter. We were till the previous quarter, we were going at the pace of 6 rupees per quarter. So for the balance 3 quarters, it's going to be 10 rupees per quarter. So the total for the year would be 36 rupees or thereabouts. With that, I'll hand over to Appa, who has some very exciting things to talk about as well. Thank you.
Thank you, Prateek. Good evening, everyone. Welcome and wish you all a great festive season. As is the practice, I would like to start with the wellness and well-being of our employees over the last quarter. I'm very happy to share with all of you that 90% of our employees and their families are vaccinated either fully or partially. And that is fairly reflective of the number of infections which have dramatically come down over the last quarter after the rough quarter we had in AMJ. And the hospitalizations are also very, very, very few. So we are really happy at the progress of the vaccination program in HCL. Consequently, we are also seeing that our employees started coming in increasing numbers to office. And it used to hover around 2 to 3%. Now it has gone up to 5 to 6%. And we are on a daily basis, we are seeing that the numbers are increasing, and we are encouraging our people to return to office. The facilities have been disinfected constantly. We have been taking care of the facilities, and people are also vaccinated to a large extent. And our leadership has almost in the past 1 month, we saw 30% of the leadership coming to offices. So this augurs well for the collaborative working, which we encourage. Now, coming to the HR metrics, CVK has mentioned, Prateek has mentioned, this is a quarter where we had our highest net headcount, which is 11,135 in our history. And we seem to be hitting the similar numbers in the current quarter also, as the demand environment is quite robust. And I'm also happy to share that we added 5,779 freshers this quarter, which is in addition to 3,444 we added last quarter. And we expect that we will hit the 22,000 freshers target, which I mentioned this quarter. We definitely are likely to hit, if not exceed, that number. So on all fronts, the hiring is quite robust for us. So we would be adding around 10 to 12,000 freshers in the next 2 quarters. And as the demand is high, and so is the attrition also has gone up. And we are at 15.69% LTM this quarter on IT services, as opposed to 11.84% last quarter. And we see similar trend in this quarter as well. But starting December, we are seeing that it has plateaued, or it is marginally coming down. So hopefully JFM will be a better quarter from an attrition perspective. We continue to have good levels of localization in US. We are always hovering above 70%, which is a healthy percentage. So that gives us the flexibility to operate in the largest market for IT services. And our diversity ratios also started going up. It took a marginal dip last year because of COVID, but we are seeing, and this quarter we increased our diversity ratio by 30 basis points. And I'm sincerely hoping that we will accelerate this much more with the focus of our board has got on this aspect. And the teams are sensitized, and we will start improving these numbers quite a bit. And we do our nationality mix also has increased to 162. Last quarter it was 157. So we are culturally, ethnically, we are becoming a much diverse organization, which augurs very well for us to be a global player. I'm happy to inform that our global delivery centers in Sri Lanka, Vietnam, Mexico, Canada, and Central Eastern Europe countries, and in US also certain centers where we started are scaling up significantly, and we expect these numbers to go up quite a bit. Our delivery centers are spreading across all geographies, which will give us a lot of resilience in our delivery model. And our focus on training continues to be very high in this high demand environment. And we have done 2 million hours of training this quarter, as opposed to 1.4 million last year, an increase of almost 35%. And consequently, our internal fulfillment has also gone up. All the Mode 2 technologies, we have our skills at scale program, and we are constantly, through academies, we are upskilling our people, which should help us in terms of new opportunities, as well as providing new roles and responsibilities to our existing employees. And well, I'm very, very happy to share that we rolled out the increments after 9 months to our junior management people starting 1st July, which is 7 to 8% at offshore and 3 to 4.5% at onsite. And for the senior leaders, it will be from 1st October. So this increment is quite high. In addition to that, we also have given certain retention. So we do hope that this will help us a great deal. Also, for all the junior management people, AMJ quarter, we paid the quarterly bonus at 100%, and we will pay 100% this quarter and the subsequent 2 quarters also. Given the COVID environment, what we see, I think this is definitely we want to help our employees in terms of having this advantage. Finally, I would like to, as CVK mentioned about the board of directors approving an RSU plan for our employees, and which is coming with a much wider coverage. The earlier LTI plan, we had around 1,000 leaders covered. Now we are covering approximately 3,000 people. It's a much wider coverage what we are trying to do. And the earlier plans were all cash plans. Now a part of it is RSUs, subject to shareholders' approval. And we do hope that it sincerely gives a better opportunity of wealth creation for all our colleagues, high performers, and that will keep them motivated and enthused. So that is we are really thankful to the board of directors for that. And before I sign off, we would like to share a few recognitions. One of them CVK mentioned is the Forbes World's Best Employers for 2021. And this is the 2nd consecutive year. And in the technology service segment, we were rated as #1 at 90th. So last year in the this is a revised one. The last year we were at around 30th, but we had a few people ahead of us, and we are very, very happy that our efforts are getting recognized by our employees and other industry colleagues, which has given us this recognition for a 2nd consecutive year. We have also been recognized as a great places to work in US, and great places for women to work in India. So and we had 4 golds and 1 silver and 2 bronze in HCM area Brandon Hall Awards. So we continue to win a lot of awards every quarter, which is giving a lot of encouragement in terms of reinventing ourselves, creating the policies which are employee friendly and best in class. So our endeavor is to constantly excel in these areas. So these are a few updates from HR side. And with this, once again, wishing you all a happy festive season. I will hand it over back for the Q&A session. Thank you.
Thank you, Appa. We will now be opening the floor for questions and answers. I would now like to request Suraj from HCL Technologies to moderate the Q&A. Suraj, over to you.
Thank you, Devapriya. Good evening, ladies and gentlemen. If you joined us from the WebEx mobile app, please tap on the three dots on the floating panel on the bottom of your screen, and then tap on the raise hand option. In case you're on your computer system and want to ask a question, please click on the raise hand icon on the bottom right of the participant panel, and we will unmute your line. And in case you have joined us on audio only, please press *3 to raise your hand. Our first question today is from Mr. Ayushman. Mr. Ayushman, I've unmuted your line. Please go ahead with your question.
My question is for CVK. Just wanted to understand if the demand environment is strong and the deal pipeline is also robust. So why couldn't we expect tangible guidance rather than double-digit growth? And what do we read from there? I mean, when we say double-digit growth, would it be in the lower teens or upper teens? What it would be like? And just some color on the overall, which geographies are sort of driving this demand? Thank you.
Yeah, Ayushman. See, with respect to the market demand, definitely it is good. We are already done with half of the year. We have the bookings and then we have the pipeline. So we have a good visibility because we've hired people, all of that. But as a policy, as we said earlier, we don't want to give a precise guidance. We want to keep this directional. But the biggest leading indicators for revenue performance will be bookings, will be the net headcount additions, which we've started sharing very transparently over the last few quarters. And that's what we intend to do going forward as well. And with respect to where is the growth going to come from, I think it's pretty broad-based. Our services business across the board is doing very well. Cloud transformation, application modernization, engineering, especially digital engineering, these are some of the top areas. Of course, there are others like security, IoT works. Maybe the scale is a little smaller, but definitely there is significant demand. And this is cutting across all verticals. And because it's more like a holistic demand, more of across verticals and geographies. That's where we see the demand.
Right. Thank you.
Thank you, Ashman. Thank you, CVK. Ladies and gentlemen, in case you want to ask a question, please click on the raise hand icon on the bottom right of the participant panel, and we will unmute your lines. And in case you've joined on phone, please press *3 to raise your hand. Our next question is from the line of Surabhi Aggarwal from Economic Times. Surabhi, please go ahead with your question.
Hi. Hi, CVK. Hi, everyone else. I just had two questions. One is, on the growth environment, I just want to understand that if the bookings and the demand is good, then what explains the drop in the EBIT and EBITDA margins? And also, going forward, could you just talk a little bit about how the next 2 quarters will be shaping up in terms of possibly the range in which the company is expecting to grow? That's one question. And the other is on this new, a plan to give shares to employees. So what is driving, what has been the sort of reason for that? Is it the talent crunch in the industry, or what is the reason behind that?
Yeah, maybe I will request Prateek to address the EBIT and EBITDA question. Then I'll come back on the growth, and Appa can do the RSUs.
Sure, CVK. Surbhi, if you look at our margins, more and more you'll have to look at services business separately, and that's the way we've kind of shown it as a separate line item in the tables that we've put in the investor release as well. You will notice that our services business was pretty flat. It was 19% EBIT last quarter, and it is 18.9% this quarter. So that is, as flat as can be. The drop at the company level is largely and primarily due to the drop in the revenue in the PNP business. One, because it is seasonally a weak quarter in the products and platforms business, but also because of those few deals getting postponed. So that has pretty much, most of that flows down in the PNP business. It's license sale. Most of that flows down to the margins. So that is the reason why at a company level it is a little short.
Okay.
Back to you,
CVK,
Surbhi.
could you also talk about the PNP business and why is it seeing a drop? Because it doesn't seem to be only this quarter. I mean, it seems to be like this quarter phenomena. So why have these deals been postponed? And
Yeah. So Surabhi, the product business and service business have a different rhythm. Service business is dependent on executing projects, having the right people available so that we can complete projects or build them for the professional services work that we do. But product business is about IP and software licenses. And when we sell new software license, there is a certain revenue recognition where a significant part of that gets recognized as revenue in the same quarter in which the booking happens. So a lot depends on bookings in that quarter. Like for example, now we're talking about September ending quarter. So it depends on the booking in that quarter. And usually a big part of the booking is skewed towards the last week, in fact, last 10 days and maybe even last couple of days. So it really comes down to the wire. And if some deals, we had some challenges, so we could not conclude them. These are in some new geographies and totally new clients for us, so we could not read the situation very well. So, but it's not really gone away. It's just going to come in OND, and so product business just delivered to the dot in the last several quarters. This is a blip, and the fundamentals of the business and it's very strong, and we are continuing to remain confident of the overall outlook for the business. We had given a low single-digit growth. Now, given the experience of this quarter, we are being cautious and saying it will be like a flat to 1% growth. And that was directionally, it's very different from the services business. That's all I can tell you. So always when you compare HCL, you compare our services business and then add to the rest of the industry, and maybe product businesses got its own dynamics. And RSUs, maybe Appa, you can provide a response.
Yes, Vijay. Surbhi, the RSUs part, I mean, see, every time we have this long-term incentive plan for our top performers, we do a market study. I mean, this is a reaction to the market study primarily, where we have realized in the last 18 months, wherever we are hiring, we are looking at people who are coming from different organizations who have got this RSU. So we also benchmarked ourselves against the competition, because we would like to retain our top talent. We would like to hire top talent from competition as well. So from that perspective, we do not want our people to get disadvantaged, because most of the people in other organizations who have RSUs have seen a significant increase in their earnings because a part of their incentive plans were linked to stock options. So hence we went and requested our NRC and board that we want to be market competitive. And that's the reason a part of the long-term incentive plan is being aligned to RSUs, Surabhi.
Okay, thank you. So we can just one last question on the growth front. Would you like to talk about how the next 2 quarters look like, especially with the PNP business? What has happened in this quarter?
Yeah. See, the September quarter is also seasonally a soft quarter for PNP. OND is going to be usually it's the peak quarter, so we expect a very strong performance of the product business in OND quarter. I mean, the long-term growth, it's going to depend on a number of factors. We've given a guidance. We will be 0 to 1% this year, and maybe the growth will incrementally get better as more products
This is
get
PNP or overall?
modernized. This is the PNP business.
Okay.
Now, the overall business, I mean, the 11,000 people, 11,500 people that we've hired, almost 97, 98% of them is for the services business. So some of them are freshers. As freshers get trained and deployed, and laterals will get billed. They were hired through the quarter, so you'll see some growth in the coming quarters. So I see fairly strong and consistent demand and growth in the services business, both on the IT and business services and engineering services. I don't want to call out a number, but obviously strong booking, strong hiring, you should make your own estimates.
All right, thank you.
Thank you. Thank you, Surabhi. The next question is from the line of Ms. Swati Murthy from Money Control. Ms. Swati, please go ahead with your question.
You have registered 2.3 billion in deal wins. Could you share what the nature of these deals are, the quantum of these deals? Because what we have seen in this quarter is that the mega deals have not been happening over the last 3-4 quarters. So if you can give a quantum of these deals, the nature of these deals, that would be great.
Sure, Swati. So $2.3 billion booking. This is net new booking. This does not include renewals. This does not include rate cards and things like that. This is all total contract value signed during the quarter. That's number one. The second aspect is this constitutes large deals and small deals. Large deals, there were 14 large deals as a part of this, which some of them we've announced, like Fiscus, Proximus. Some of this we've announced. We also signed a very large deal, Mexico-based large global manufacturing firm. Gave us an integrated services deal. There are 2 large healthcare deals. Both of them are in provider segment. I mean, this is again a very strong segment where we've grown 20% year on year. We have good bookings. We announced Proximus, which is a very large telecom modernization deal, where we're going to offer, we're going to modernize their data centers and then also create a private cloud environment with public cloud-like features, which they can offer to their clients. And there is a joint innovation lab that's getting created, which is the largest deal in the quarter. So this is the flavor. It is there is a lot of momentum in our existing customers, where there is some of the application modernization and cloud migration work is happening. These usually come as scaling up of these accounts on a T&M mode or on a fixed price, but on a smaller chunks. So all around momentum, I talked about digital engineering, which is where not only in the high-tech and telecom segment, the MMT segment or asset-intensive segment also helped significantly deliver good growth in the engineering services. I hope that gives you a good flavor of what happened in the quarter.
I was looking more for the value. So what is the value what you are talking about? 500 million, 400 million, $100 million when you say largely, if you can share that. Not specific to one customer, but the broad base.
Yeah, we don't have a 500 million kind of deals. It is 100, 200 million, that is the ranges that we're talking about as a part of this count. Unfortunately, we don't have a $500 million deal, but a lot of mid-sized deals all added up to $2.25 billion.
Is this the flavor you're seeing in the coming quarters as well? The $100 to $200 million deals from small to mid-sized deals?
I think, it'll be a good measure to say 50 to 200 million is where the bulk of our pipeline would be in terms of large deals. Very few, larger deals or smaller deals. I think this is the range. 50 to 200, I would say, is the highest in terms of the deal sizes.
Okay. Apparao, just a couple of questions for you. One is about the attrition, which is at 15.7%. You have introduced stock options to retain the employees. There was a report that you're also looking at giving bends to high performers. So is it still there, that plan? There was a report which said that.
No. So we have done that till 2013. Right now, currently at this point in time, I don't think there is any plan we have of doing it. But there is a leadership plans what we have, but how they pan out at this point in time, it's very difficult to say.
What leadership plans for the high performers apart from the stock options?
Apart from the leadership plan is basically the succession plan. So we have identified our leaders, the next generation leaders. So obviously we have to look at how they progress in our organization and where we have to baseline benchmark them. So as part of that process, if something comes up at this point in time, very difficult to say.
Okay. Are there any other interventions you are looking at apart from stock options and the 100% variable pay? Because you're also competing with Bharat Pay and other companies which are giving out BMW bikes and IPL Dubai tickets.
Yeah. I did read about them. But I think our philosophy is that the junior management people, we should give cash to them. And senior management people, we should give an opportunity for wealth creation, especially the top performers. And that philosophy we continue to hold, and that is reflecting in our compensation and benefit policy.
Okay. And just one question, which is into two. One is, are you looking at increasing your fresher hiring, which is at 22,000? Are you looking at increasing it? Second one, about return to work. You spoke about how 5 to 6% employees are returning to work, and 30% of the senior management has returned to work. Do you have a policy in place? If you can talk about that. These are the two last.
Yeah. So I'll address the return to office part first. Yes, we have a policy in place. We have encouraged and our senior managers to come to office at least twice in a week. Right. And depending upon the roles, customer requirements, data privacy guidelines, all those things, each line of businesses is encouraging the people to come at least once in a week. So we do expect this momentum will increase by end of this year, this calendar year. So that is definitely is a policy what we have at this point in time.
Thank you, Swati.
Sorry, the second question you mentioned, you asked another question.
Yes, the fresher hiring. Are you looking to increase the number of freshers?
Absolutely, we are going to increase next year. This year we will hit the 22,000, and next year we are at this point in time we are targeting close to 30,000.
Thank you, Swati. Thank you, Appa. Our next question is from the line of Ms. Bisma from Business Today. Ms. Bisma, please go ahead with your question.
Follow-on questions, most of them have been covered. I just wanted to understand from Mr. Apparao the costs of talent acquisition, whether the costs have gone up during September quarter, and whether that has dented margins, impacted margins, Mr. Aggarwal, this quarter. And also, you spoke about that there would be 3,000 employees, right, who would be covered under the RSU policy, which has been approved. So would that, would it also cover the junior management, people as well? And the last question is for Mr. C. Vijayakumar. So I wanted to understand, of course, you've said that there was an addition of $100 million client, right, this quarter. So from here onwards, we've spoken to the industry analysts who say that the digitization spends, especially, when people are returning to work, it might go down, it might taper down. So what is your viewpoint on that? Would, deals in that particular value, $100 million or above, would it be hard to come by for the next few quarters? Would it be a mix of small deals and, mid-sized deals? And do you see a slow demand on digitization front in the next few quarters? Yeah, that is it, sir. Thank you.
Maybe to make it easier, let me address the last question, then I'll ask Prateek to address the margins and Apparao on the HR question. See, in terms of client additions, when you say $100 million clients increased by one, it doesn't mean that we won a $100 million deal, which has helped increase. It is really our annual revenue. A lot of these clients are long-term relationships where we keep growing based on the various initiatives that they spend on. And at some point, they cross different milestones, 20, 50, 100. That is what we call as client categories. Now, you asked another question, interesting question. Because of return to work, are customers going to spend less on digital transformation? Absolutely no. Customers are looking at their digital transformation as a very important business intervention to transform their business. And it is not a one activity to just do this and then you are done. It's a series of activities, and there is a real visibility of some of these large programs for several quarters. And digital transformation has also multiple steps in the journey. You have a concept, you've implemented it, then you are going to look at how, what is the return it is delivering. If it is really doing very well, then you are going to double up and spend a lot more. Similarly, when you do cloud migration, you transition a certain workload and certain business process and application to cloud. Then once you are in cloud, there are so many other opportunities to leverage the functionalities of cloud around data, a lot of integrations, the open architecture. So that gives the next leg of growth. So we see this as not a short-term thing, at least a medium-term growth trajectory. With that, I will hand it over to Prateek for the margins question.
Yeah, thanks, CVK. That's a very simple answer. We all know it, right? It's basically the average cost has certainly been going up, and it manifests itself in multiple ways. So Appa spoke about the higher payout percentages, whether it is variable, bonus, whatever you call it. Obviously, when you are hiring in such a heated market, the new people who are coming in, the lateral hires are coming at higher costs. The people who are tried, the backfill is also at a higher cost. And then we are paying, skill allowances for people who get certified in certain disciplines and certain practices. There are skill allowances for that. So it comes in multiple various forms, the training cost. So it is going up, and it's definitely having some impact on the costs. There is productivity on the other hand, and that's why we are at 18.9% in the services business, like I called out a few minutes back.
There are no more questions on the panel. Thank you, ladies and gentlemen. Back to you, Devapriya.
Thank you, Suraj, and thank you everyone for your valuable time and presence today.